Hey, everybody, and welcome to Growing Wealth Through Home Ownership. And I am Sandy Krestan with the Krestan team. And I am so excited to have you here today because I know without a doubt the stats and facts prove it that home ownership is the #1 way in the United States of America to build long-term wealth. And the first step is with you and I being here today. So welcome. I'm super excited about having you here today and kind of talking through the facts, maybe some of the fiction that you're hearing out there that just straight up is not truth. So welcome. We're going to talk all about your home and your money that matters to you. It matters to me. So we're going to come alongside of you on this journey of being able to buy your first home, another home, and just know when you have questions, I'm going to absolutely give you all the information to be able to get directly with us, and we'll be able to answer those questions for you, as well as we're going to send you a great roadmap and home buying guide and credit guide after we're done today that you'll have available to you to use in the future. So come along, let's get on the journey to being able to get your mortgage 101, the basics, and maybe a little bit more. So our goal is that you're able to walk along, know this is a safe place to ask questions and get answers and schedule a time if you want to talk specifics with you. So today we're talking homeownership, and it still is the absolute American dream. I bought my first house in 1987. And because of that first house, that was not probably like Chip and Joanna Gaines. It had the basic countertops and it had the basic floors. But that home led me to my second home, which then led us to the third home. And so I'm going to walk you through the journey of, yes, I do this every day and I've been doing it for 39 years. But when I bought that first house, I had only been doing mortgages for 3 years and I was young and I had someone else kind of come along and help me. So yes, it's still the American dream. It is normally the largest asset and the largest debt of most of our lives, maybe except if you've gone to medical school or law school, you might have more debt than a mortgage. So we're going to talk about how home ownership builds affordability, stability, security for families. We've already talked about it is the #1 way to build wealth. So if you're going, oh man, why did I not buy in 2020 or 2021 or even the beginning of 22? It's okay. The second best time is right here, right now. And I'm going to share with you some of those facts along the way. So we want to help you make a good, sound mortgage decision. That's what we're all about, giving you great advice so you can make that informed decision. I always like to tell everybody, listen, I'll give you my opinion because I kind of think after 39 years, it might be worth listening to. Doesn't mean you have to follow it. It just means you may want to listen to it. So, and we want to absolutely, kind of show you the facts of what it's like to be renting versus buying. So if you've got questions, just add them in the chat. We are recording this. I'm going to send a copy of the recording. I know it's maybe a day of the week where not everyone's available. So we're super excited that you're here. So right now, even after all this time since the markets really started shifting in January of 22, got a little bit more shifting in the summer and October where rates kind of went up. There's 3 questions I'm getting every single day. And I don't care if you're 24, 44, or 64. These are the questions we're getting. So what's going on with the value of homes? And if you already own, you want to know what's going on with the value of your home. What are interest rates doing? And honestly, like facts, not fiction, is it a good time to buy? And I'm going to answer that for you with facts. Now, so what I want you to keep in mind is when you're on the internet and you're out on Google or you're in Facebook or Instagram or watching the news, if you have a TV subscription, they sell fear and doubt. That is what pays them advertisers to be on their channel. So I want you to remember, everything you read online, everything you see on TV may not be true. In fact, dare I say, probably not true. So we're going to give you the facts behind these 3 questions I'm getting. So yes, I am Sandy Krestan. That's what I look like. My team and I are over at Fairway Mortgage. So I started in the business right about here, 1984. So for 21 years, since 1975, we had interest rates over 7.5. And remember, I don't think I told you, 1987, my mortgage interest rate was 10.5%. And so I already know you're going, yes, but Sandy, the house costs a lot less. But let me just remind you, we made a lot less money in 1987. So rates for 21 years were over 7.5%. 16 years, the next 16 years, they were over 5%. And I want to challenge us in our mindset. And let me just tell you, would I love for interest rates to be down in the 3s again? Heck yeah. But I want us to keep in mind, 39 years now of doing this, and those rates were the lowest I have ever seen. So I want to try to get us realizing what is normal is rates higher than what they were. Now, do they 6.5, 6 7/8%? You know, I don't know if it's right for you. We're going to talk about some of that today, but I just want to get us all kind of in that same perspective of the facts and the fiction. So if you've opened up the internet, you've kind of heard things and you've heard people talking about, oh my gosh, mortgage rates. Yes, they've gone up. Here's a chart that goes back to August of 19. And so I want to just say, yes, that's lower than it's ever been. It jumped up, it goes down. It's kind of a little bit like a roller coaster, right? We have someone give us news that scares a little bit, rates get higher, then things come down. And when mortgage bonds go down, that means rates are going to go lower. And so I just want you to realize that they change every single day. And until you're in the mix of it, getting pre-approved and shopping, we'll go deep in a specific interest rate for you, because there literally is 26 different factors that can go into quoting an accurate real interest rate. So if you're online looking at interest rates from one of the online lenders, there is about a half a page of size 6 font, maybe size 4, disclaimer adding points for what they're quoting you for an interest rate. So keep in mind, if they haven't asked you 26 questions, then it's probably not a real interest rate. So where are interest rates going? So love this question. And here's the thing, we're in a little bit of a moving target right now. And this is not political. This is just facts with our Federal Reserve chairman, is that saying, you know, the things that have always in the past happened that cause, and we get that, and we see interest rates should go up or down. Right now, that's happening, but the opposite is happening in the ways of Federal Reserve. This week, they raised the prime rate, which is not mortgage rate, but prime rate, the overnight Fed bank rate, by a quarter. But every indicator before this in the last couple of weeks really showed they shouldn't have done anything. But they didn't. So it's a little bit of a wild card right now. We're out in the Wild West of what's going on with the economy. Every one of the top rate mortgage economists out there are saying they're going to come down. They absolutely are. Where exactly, we're not sure when exactly, but they will come down in the next year or so. So we want to talk about a couple different things. We want to talk about the amount of homes available. So right now, there's not a huge inventory. And so what that means is we've got buyers out looking, and we have buyers out looking right now, even at rates at 6.5, 6.75%. But there's not a lot of houses to find. So if you've got a house that looks like Chip and Joanna Gaines, you know, touched it and made it beautiful, it's going to have some multiple offers right now. So there's a lot of homes that you could go out there and get where maybe it doesn't look like Chip and Joanna, but you're willing to do a little bit of elbow work, paint, So you're going to be able to get there now with less other buyers looking at it. So what happens is fewer buyers are looking at 6.75. When it goes down to 5.75, there's going to be a lot of buyers on the fence going after those same houses. So we're probably could see multiple offers again. We could see some things that happened before, but I want to encourage you, and I'm sharing this with you because let's look at the number of houses available right now. It's pretty low, right? And if we look comparing, because one of the things that people are saying, oh my gosh, this is like 2007. It's all these houses are going to be flooding. I'm going to wait till the market drops. And I just want to share with you back in 2007, 8, 9, 10, 11, 12, because it didn't just happen in one year. We had about 35% of distressed sales. And today, we are sitting at less than 4%. So as you can see, 35%, 4%, big difference. But if we go back to where the inventory was, how many houses were available and up for sale in that same 11, 12 period, look at this number, man. That is so much higher than where we are today. So there were deals back then that aren't going to be available right now because we don't have the amount of houses on the market. We don't have hardly any distressed sales. And then the fact is, if these numbers looking at distressed sales, the average person in America that owns a home has over $100,000 of equity. I can almost promise you, unless there's a health problem that they can't make the decision, someone's going to sell their house before it goes into foreclosure because they could lose 50, 60, 70, 80, $90,000 hard cash by letting it go to a foreclosure. So I'm trying to give you the facts to what we're seeing in the news that isn't really facts. And then this is a national number, and it's coming out on where we expect year over year, where we're at a pace for appreciating in the homes in 2023. And this is pretty cool. It's ranging anywhere between 5 to 10%. Keep in mind, real estate is a ridiculously local thing. So if you're in Arizona, you're going to have one estimated appreciation compared to Florida or California, Minnesota, Nebraska, wherever else we might be licensed. It could be a little different. So we want to make sure we get you hooked up with a great real estate professional that knows what they're doing and is protecting your assets and not their own. But this is great news. So even if we look at rates have doubled, and what's going on right now, we're still seeing these homes appreciate at a good clip. So it's just another reason why you don't want to wait to buy if you can. For example, I'm going to use this number because it's nice and easy for me to round it. If you're looking at a $500,000 house today and prices do appreciate this year and they're up at 550, that mortgage payment is going to end up being higher because I don't know how quickly rates will come down. So I just want to kind of do some of the myth busting of what you're seeing on the news. I love this and I hate this at the same time, right? If you have a mortgage payment of just $1,600 in 5 years, you've now spent $96,000 paying your landlord's mortgage payment, helping them grow equity on that property as it appreciates, helping them get the tax benefit. And you guys, yes, you get to live there, but you don't walk away with anything in your pocket for that money. So I just want to encourage you as you start on that road to home ownership, for us to take a look at what you're spending right now on rent, number one. And then number two, as you're out there checking out houses online to purchase, and if you think, oh my gosh, that is so high, what I want to do is have us talk and look at how much are homes going for in that same area, like the home that you just fell in love with online. How much are they going for to rent? Because we want to make sure we're comparing apples to apples and not oranges to apples. So think about that as you're renting, that, you're paying the money, you're not getting the appreciation, and you're not getting the interest deduction. You're not getting the equity through paying down your mortgage. So why, Sandy Krestan, should I listen to you? Well, number one, I have been doing this for 39 years. I've never done anything else. We put our clients' best interest before us. I started out in this business in 1984 as a support person, as a loan processor. And I laugh and I say I learned pretty much everything I needed to know in that first 3 or 4 years of doing mortgages that have taken me to this day. I love reading guidelines for fun. Our team asks the questions to get the answers to give you the best advice possible. I'll tell you a little story from the street. I got a phone call, which is almost 3 weeks ago. It'd be 3 weeks this Sunday, from somebody who was with another lender and they were going to close late. It was going to close after the contract date, which is not good. And then the lender kept kicking it down the road, kicking it down the road. I got the call yesterday, 2 weeks and 5 days after they first called me, that the other lender can't get it done. And so I'm going to give them a consultation. We're going to figure out, can we do it? Can we not do it? We're going to get it done. So not everyone has that ability, and not everyone's willing to roll up the sleeves and do the work that it takes to put your best interest first. So what are the different types of lenders? Who knew, right? There are about 4 different kinds of lenders. Now, the private funds, sellers, investors, that's not something that most of you guys as my friends and our family and our coworkers would ever go with. That's maybe like a hard money lender that is doing some short-term financing for whatever reason. Now you have brokers out there. Those are ABC, Buy Me a Loan, kind of funky names. You got to remember, they don't use their own money to lend. They have many outlets, but they lock in with one investor. So if that investor has long-term times, you're going to get to wait, because you get what you get and you don't throw a fit. And then when it's time to get closing documents, that resource does them, not the person you talked to initially. So then you have the mortgage bankers. That is one outlet, Wells, Chase, USA. They just have their resources. I don't know if you know this, but USAA and Wells Fargo at times create minimum credit scores that FHA and VA and Fannie Freddie don't have. So they put extra, what we call overlays on top, so it makes it harder to qualify. And then what I am is a mortgage banker and a broker. I really look at it as the best of both worlds. We are a mortgage banker. We work directly with Fannie Mae and Freddie Mac. We have our own processors and underwriters and closers and our own money, which is huge. And we're able to say, hey, we need a rush, and we get it done. So that's great. But there are some certain types of loans out there that maybe on a day that Fannie Mae and Freddie Mac aren't the best price, I have the ability to look at interest rates for Citi and Chase and Flagstar and Wells Fargo and about 18 other lenders on any given day to see where their rates are, so we get the best rate that we have available for you. We use our own funds, which means the money will always be there. Now, I guess I am biased, but I'm not biased. I really do think that's the best of both worlds. So those are the different lenders, and they can sometimes deliver different quality of service. And the big thing to keep in mind is, once we have you pre-approved and you're ready to make that offer on a home, I'm making a personal phone call to that listing agent selling your pre-approval. And even if we don't have a multiple offer situation, it's really important that I can make them comfortable with you, that they in turn, as the listing agent, talk to the seller and get them comfortable. And if you're a broker that doesn't work weekends, a big bank that doesn't work weekends, a call center that doesn't work weekends, that doesn't work for you. So credit score, this is huge. You know, I remember when we actually didn't have credit scores. That dates me. But they happened, and they're kind of like the secret sauce formula that they don't tell us exactly the formula that it takes to get there, but they kind of give us a glimpse and clue into it. So it's a scoring model that's used, yes, for mortgages. They look at your credit score for insurance. They look at your credit score, obviously, auto loans, credit cards. your credit score is used for everything now. So it's important that you get it as high as possible. But I'll give you that same little thing. Be careful what you read on the internet. We've had clients think that what they found on the internet is true, and it's totally messed their credit score up and did the exact opposite of what the borrower's goal is. So let's talk about it. How you've made your payments in the past accounts for about 35% of the score. And keep in mind, the further we get away from a late payment or a collection or a charge off, the better you are with your credit score. And your history is about 15 to 20% of the score. And how you utilize credit is about 30%. So, for example, you have a credit card that has $1,000 limit and you have a balance of $1,100. You're actually over the credit limit. That is going to hurt your score. It's going to drop. Literally, the day they report it, your credit score will drop. On the other hand, if you have that same $1,000 and you never bring a balance over $300, continue to make the payments on time, that is going to help your credit score. And that's the amount of credit utilization, the amount you use to your credit limit. And then the type of credit you use is 10%. So are you always using credit cards? Do you have an auto loan? Do you have a mortgage? How are you using your credit? And then your inquiries. And this is the big one, I know, what everyone thinks when they're shopping for a mortgage. Inquiries are 10% of your score. So I want to keep this in mind with you. I'll give you a piece of advice, and I told this to my son when they went looking for a car in January, is if you're going to look for a car, don't stop at 6 different dealers and let every single one of them pull your credit history. That is going to hurt with your inquiry, right? You have an idea of where your credit score is. Go on to your bank app, go on to your credit app. Credit Karma is not real. Try not to use that one. But go shop, find the car that you like, find the dealer that you like, tell them where your credit score is. Don't let them talk you into getting a credit inquiry. They're going to try it, but don't do it. Get an idea where the rate is, shop the rate, and then you buy the car and let them actually pull your credit. So the difference is for a mortgage credit report, that mortgage credit report actually, for a lender that goes and has another inquiry within 30 days, that inquiry will not affect your credit score. It's a little thing they do for your mortgage so you could shop. So here's the thing now. That doesn't mean that your credit score yesterday on Friday will be the same on Monday. Because if you went shopping on Friday night and got your credit card balance over your limit, it will be a different credit score when the other lender pulls it. So it's looking at your credit score is kind of giving us an idea of the risk that you carry. So you got great credit, less risk. Really low credit carries more risk. So the best effect for if you've had some bad things happen, and first of all, everybody has at some point in their life. Time tends to cure everything. So start making your bills, paying them on time. You're going to get in the right direction. So what happens if your credit score isn't perfect? So like the 780 score on the screen right now, that's not the average credit score in the US. It's somewhere about 704 for the average credit score. I think the highest one I've ever seen was like 828. And I've seen that like once or twice. So if it's not perfect, we as a team, remember I told you, don't go look at the internet, don't pay somebody to do this. We will do a credit simulator for you once we pull your credit, and we'll help you build an action plan with what you have to do, how long it's going to take, and where they estimate your credit score will be. And we're going to come alongside of you, and we're going to help you with your credit. I'm not going to pay it for you, but I'm going to be there as your coach and mentor and teacher and come alongside, check in and see how you're doing. Because the better your credit score, the better the interest rate, the more opportunities for loan programs, the higher the payment that you qualify for is. So we talked about this. Your credit report is good for 120 days. So we can get you pre-approved today. and you could go and find a house in 90 days, that credit report is still good. So you might be thinking, okay, great, Sandy, I'm in a lease and I'm not out of my lease for 5 months. So if we get you pre-approved today, yes, we would have to go and check your credit again to make sure it's still good. But as long as we close within that 120 days, if you do buy that during that time, then we don't have to get a new credit report. So there is 5 things. There's a lot of stuff. I'm not going to lie. It's the largest asset. It's the largest debt. But there's really 5 things every homeowner, future homeowner needs to know about getting a mortgage. So we're going to go through here. Listen, talk to me first. I know I'm not the only loan officer out there, but I know I'm the loan officer that's going to look out for your best interests. And so I tell every single person, you and I are going to become like new best friends. I'm going to be your built-in therapist, psychologist, built-in bartender. I'm going to be there for you as your new best friend to answer your questions. Text, call, email. If I'm awake, I'm going to answer. Pretty simple. And then we're going to get into some things not to do for you. And that way we kind of keep you out of the trouble zone. I can't fix it if I don't know about it. So that's that whole like best friend therapist kind of thing going on. I'm Switzerland, and you tell me what's going on. I'm going to be able to tell you what we need to do to be able to get you to your goals of becoming a homeowner. So here's a roadmap on the loan process, and I am going to send this to you. It's out on my website. You're going to be able to find it. But it's a pretty epic journey you're getting on the road to doing. And like any journey, you've got to plan for it. I always say this is in that, I have people plan their vacations longer and take more time with a vacation than buying a home, their largest asset and largest debt. So we're going to come alongside and we're going to make sure before you get on the road, the first step is always going to be your loan pre-approval. And so what that looks like is we're going to either get in person, on the phone. You can always do the actual loan application online, but I want you to keep in mind this. It's a government regulated form and there's a lot of things to fill out. And so even the person who thinks they did everything hasn't done everything. There's always a reason. We're going to have to jump on the phone. We're going to do 5, 10, 15-minute consultation just to dot the I's and cross the T's. Because when I issue your pre-approval, you are ready to go. So we want you thinking about what you're going to feel comfortable with. So we're going to get you fully approved. We're going to talk about what we need and what that process looks like. But the application is really looking for 2 years of work history. But here's a quick thing. College is considered a work history. And when I ask you specific questions, there are times when you can have a shorter history, even if you didn't go to college, and we can use that income. So we're looking for a 2-year address history. We're really looking at just getting to go deep with you in a conversation to find out as much as possible. So we got to get you completely pre-approved, because the worst thing that can happen is me tell you you're pre-approved, you go out shopping, you fall in love with the house, and then I couldn't deliver. It's just not going to happen. So we'll take that loan application. We'll get you where you give us the documents. I will pre-underwrite every single one of the documents. We will put it through the automated underwriting because, everything is done by computers now. And we'll be able to see what we can get done for you. We'll actually look at that comfort range. We'll also look at a max number that we can get you pre-approved for. And then number 3 is, what's your comfort range? You need to know the monthly payment that you are comfortable with. You can look at, what are you paying right now for rent? I always suggest, and if you'd love a budget, just shoot me an email at sandy@thekrestanteam.com. I will give you a budget tool that's awesome. I will sit down with you and go through your bank statements and credit card statements to help you build a budget. You need to look at what you're spending if you're not renting right now to find out that comfort range, because I can promise you that the last thing that I want to have happen is you get pre-approved, you get under contract, you buy a home, and you're not comfortable with that monthly mortgage payment. You're cursing me, my name, and I'm not going to let that happen. That's how we've been around as long as we have. So we want to look at the budget. We want to figure out what you're comfortable with. I don't, want you to have to eat ramen noodles the last 2 weeks of every month because there's nothing left after your mortgage payment. So we've got to know the comfort range in the budget. And so once we get the loan application, you told us your budget, we're going to look at the documentation we need in order to give you a complete pre-approval. And honestly, it's actually pretty easy. So if you're techie, you can upload them through a secure portal, which is awesome. So what are we looking for? If you're not self-employed, we're looking for a month worth of pay stubs, most likely 1 or 2 years of your W-2 forms, not your tax returns, your W-2s. We need to look at where the money is going to come for the down payment, the earnest money. So 2 months worth of bank statements, a copy of your driver's license. And then when we do the loan application, we'll figure out the different products that become available to you and go through that with you. So the application, 15, 30 minutes, we get the documentation, we pre-underwrite it, and we literally can then, once we pull your credit, issue a pre-approval. But these are the things I need you not to make changes with because they could cause that pre-approval that I handed you to go flush down the toilet. So when in doubt, call me. And pretty much once we have you pre-approved, other than going to the bathroom, if you're looking to make a big charge, if you're looking to change jobs, if you're looking to move money around, if you're looking to buy a vehicle, sell a vehicle, apply for a new credit card, if you're looking to close a credit card, if you're thinking you're going to skip a payment, don't do it without talking to me, because I will look at the good, bad, and ugly and tell you how it affects your pre-approval. I'm not going to tell you not to go do it, maybe, but I'm going to tell you how it affects your pre-approval so that you make that educated decision, and then you can decide what you want to do. But really don't make changes once we have you pre-approved without us talking, because I can let you know how that affects your pre-approval. And transparency. Listen, we love to communicate. Not always calling you. It could be text, it could be email. It's walking you through all of the steps to be clear, concise, and know that you're in great hands with our team. And I can't fix it if I don't know about it. So I'm going to teach you about mortgage insurance because it kind of has a little bit of a bad rap out there. So it's commonly known in the industry as default insurance. And so when you do not put 20% down on a conventional loan, you have to have mortgage insurance. And the cost varies on a conventional loan depending on your down payment and depending on your credit score. An FHA loan only requires 3.5% down, and no matter how much you put down, FHA has mortgage insurance the whole entire time. If you happen to be a veteran, there is a VA funding fee, and there are veterans who are exempt from paying that funding fee. And then maybe you aren't exempt, but it can be lower amounts depending on your down payment. So it's basically insurance on all of those different programs that helps if you stop making your mortgage payments, helps the lenders recoup the losses from a foreclosure. And foreclosures cost real money. And that's part of what happened in 2007, 8, 9, 10, 11, and 12. On why some mortgages got more expensive, because a lot of mortgage companies and banks got stuck holding the bag with the cost of the foreclosures. So what about if you're looking at a townhome or a condominium? They have monthly homeowners association dues, and that's just a monthly amount that you pay to them directly for what you get around you. So if you're in a condo, maybe you have a workout facility, maybe you have a community pool, a townhouse could have that. They have some parks. That is an amount that you pay. Now, so when you're checking out houses online, you're going to see that under HOA dues. So just know that right there, you need to let me know about if you're looking at condominiums. because that eats up your buying power. Funny, we just had a condominium that's new construction for a borrower, and the monthly assessments were almost $500. And so that $500 equated to about $60,000 in buying power. So that could cause the loan amount and purchase price you qualify for to change. But that's one of the things that we'll talk about when we do that application. And then mortgage interest rates. It's been all over the news. And so it's the most frequently question I get. What do you think rates are going to do? And when I look at my crystal ball, they're going to go up and down. Will they come down eventually? Yes. But I will tell you, in 39 years, they go higher quicker than when they come down. So you and I will talk, we'll look at it, we'll see what it does. So I want you to not really focus on rates here. I want us looking at that monthly payment, because when you stop being a tenant, you look at that monthly payment. That's going to be a portion of it, most likely is tax deductible. A portion of it is going so that you're building equity through your principal reduction, and then you get the appreciation. Will they come down and we could save you money? Yes, hands down. And we watch it every single day for our clients. But just know, think about the monthly payment you're going to feel comfortable with, and just know rates will come down and then we'll get it lower for you. But they do change every day. And we had a day Thursday where it changed in the middle of the day and got worse. So we communicate. You have questions, we're here to help. So on that same thing of rates, like my teeter-totter, I don't even know, do we have teeter-totters anymore? Right now, there's a higher interest rate that costs you no additional funds for that interest rate on any given day. And so what happens is you could say, well, I want a lower rate, but that's going to cost you more money at closing. Those are points. And so we'll look at those side by side. We'll put them in black and white writing and say, okay, here's the no point loan. Here's the payment. Here's the next option. Here's the payment. But here's what that's going to cost you. And it could take you 2, 3, 4, 5 years to break even. And we'll look at how long you're going to own that home. You could see yourself living there and figure out what's best for you. I'll give you my advice. You could do whatever you want with it. But rates can change, and you have different options for rates every single day. So we've met, we have your credit score, I have your documentation. We're going to look at the loan options. Are we going to choose a fixed rate? Maybe look at an adjustable rate. Are you a veteran that qualifies for a VA loan? FHA is a government regulated insured loan, and depending on the county you're in is the maximum loan amount. But you only have to put 3.5% down for an FHA loan. FHA is a little bit more forgiving on credit score. So when we do a side-by-side comparison, you may see on one day for one person with a lower credit score, maybe FHA has a lower payment to a conventional. And then someone else tomorrow has a higher credit score, and so maybe that conventional has a better payment compared to an FHA. But we're not going to assume, and I'm not going to tell you what to do, but I will put them in front of you to make an informed decision. So that depends on FHA, where you are, what county for the maximum loan amount. USDA is commonly known as rural housing. Doesn't mean you have to be 90 miles outside of a city, but there's an actual website that you look at to see if the area that you're looking at qualifies for rural housing. And then a jumbo loan is just, right now, the conforming loan limit is $724,000 and $724,200. Anything over that makes it a jumbo loan. So we're going to take it and look at your options. The other thing is we've got some great first-time homebuyer programs. So they are down payment assistance programs that can help you with closing costs and down payment. And it is, nothing is free. We all know that. My grandma Lil said, nothing is ever free. There's always a cost for it. So some of them have to be repaid. Some of them can be forgiven after a 3-year period, after a 5-year period. So we'll do a comparison, but it's awesome for first-time home buyers because it helps you get in to that home where you might not have. So if you've been employed for a while, and maybe you might have an old 401k sitting somewhere that could be leveraged for a down payment. So we'll look at all of those options, and you might think, wow, Sandy, you're asking me a lot of questions at the loan application. That's because we want to get all of the information so that we can help put in front of you a comparison of the different loan products that gets you in the best position for you. So when you hire us and you get a mortgage, it's just not me. And it's just not Pam on my team, who's also a licensed loan officer. You are going to have our loan processor working for you as well. She becomes part of your line. I'm a football fan. So she's there. We take the initial loan application, we get it all together, we get the loan disclosures to you, and you e-sign them. Then we hand them off to our loan opener and our loan processor. They do all the rest of the dotting of the I's, crossing of the T's. They'll order your verifications of employment. If for some reason you can't find a bank statement, we'll do a verification of deposit. They will be the person that the appraisal comes back to, and they'll put it all together. And they actually, because we don't use paper anymore, it's all digital, they will push that loan to our loan underwriter, and our loan underwriter knows all of the guidelines, and they're going to look at your credit and their income documents, and they're going to tell us they approve the loan. So I pre-approve you, and they give you full loan approval. Now, if there's something that I'm not 100% sure that it will work, we will send it through our process even before you find a property, so I can give you 100% that we will close. And then keep in mind what the underwriter's looking at is they're looking at your capacity. Do you make enough money? Where's your credit at? And then when you're under contract, what does the property look like, right? We can't be seeing there's termite damage that hasn't been fixed. Is the current the offer that you've made more than where the comparables come in? We don't want you paying more than you should. So remember though, and now we're full blown into this, we're probably 5 or 6 days, you're already under contract. Keep all of your important documents not packed away, because sometimes technology is not 100%. The underwriter could ask for something for clarifying. We try to get as much as we can up front, but there's sometimes when something you give us causes us to have another question, and we might need another piece of documentation. So remember, normally we're closing in Arizona 21-30 days. Most of the other states where we're licensed, it's less than 30 days. Sometimes we can close in 15-60 days, 15 to 16 days. But you have to remember, when you see something from Pam or I or our loan processor, jump on it, get it done. If it's something important, we're not just going to email. We're going to email, call, text you, so you know it's there and we need your help. And so one of the best compliments I ever have gotten from some of my clients is that I'm scrappy. And you don't often hear that word when it comes to loan officers, but I'm actually really proud of it, because I get us to the finish line. We don't close late. We don't close ugly. That doesn't mean it goes ugly. It just means that I'm willing to fight for you. I'm willing to put my battle armor on and our full resource of our company to go to work for you. And I'm okay with that. You know, I'm here to look out for your best interest. So after loan approval, after the underwriter has it, it comes out, we have loan approval, and we will let you know any conditions that the underwriter has. And once we have all of those, she'll submit it back to underwriting, and then they'll give us this thing called clear to close. And that means the appraisal is in. And by law, you have to get a copy of that appraisal. We want you to have a copy of that appraisal. By then, we're going to have the title insurance company. We're going to have their history of the property, so you can see, is there any liens we didn't know about? Are the taxes all paid by the seller? If the property would be in a flood zone, we'll make sure that you know that you need flood insurance. And then you have to get homeowners insurance. Even if you're buying a condo and part of that homeowners association dues takes care of the building, you have to get homeowners insurance for a condo on the contents, and everyone else for a townhouse or a single family detached. You're going to get a homeowners insurance, hazard insurance. Now, if you need a second opinion, we have a great agent that we work with and we love so much and takes care of our clients. We're always looking to get you the best deal that we can. So then we're ready to go to closing. You are almost there. You are almost a homeowner. This is the best part. So you're going to get a closing disclosure, just balancing with the title company, balancing with the listing agent, with us, and there's going to be your bottom line number. Normally, it's at least 3 days prior to closing. You're going to e-sign that, and then when we balance, we're going to tell you the bottom line number that you need to have either as a cashier's check or have wired to the title company. Now, wire fraud is real right now. And so I'm just going to encourage you, the title company will give you the wiring instructions, but if you ever have a question, just get with us and we'll make sure that you're good to go on the funds that you need. So who will be at closing? There's a title company person. There could be a mobile notary that signs you. I'm not normally there, but literally I am a call, text, email away. Just know though, even though I'm not there, we have reviewed the numbers. We know the bottom line matches what we told you. There will be no surprises. Now, there are some states out there where they have attorneys at closings, and your real estate agent may be there, right? But I'm a phone call, text, or email away, as well as the team. So what happens next is you go and sign, everything's dotted, crossed, you send the money to the title company, we wire the money to the title company, they have all of that, they send that deed of trust to the local county for recording. And once that's recorded, you are a homeowner. And imagine what that's like. Now, I put this together for you because there's a lot of things, as you might be feeling, as we go through a calendar of all the things that happen in the sometimes 15, 30 days that we make it happen. And that's so you can see there's a lot of moving parts. So if you ever feel concerned or discouraged, or you're not quite sure, just let us know. We will keep you up to date. We'll give you a loan status update every single Tuesday. But then in between that, when things are happening, we're going to shoot you a quick email so you know. Fear and doubt has no place in buying a home. And I know with all the years experience that when we're not communicating, any lender doesn't communicate, that's when fear and doubt comes in. So we communicate. You will hear from us usually at least twice a week. So after we get through all of the moving parts, you are almost there. So some of the tips I like to tell my future homeowners is, listen, there's no obligation to use a realtor, but I want you to keep in mind when you go to look at a house, that real estate agent that you have as a buyer agent, and I can get you a referral, is paid by the seller. So that's not money out of your pocket that you have to pay, right? And there's no money due from you until you make an offer on a home and it gets accepted. Once it's accepted, you're going to give earnest money, which means I'm going to put a deposit with the title company saying, hey, I'm in it to win it. This is real. I'm not just going to back out. So, and that'll depend on what you write in the contract. It could be $2,000, it could be $7,000, depending on the price range. Then you're going to want a home inspection. So you would pay the home inspector. And then once we had the home inspection back and assume everything is great, then we're going to be able to get the appraisal ordered for the loan. Now, if the home inspection comes back and there's things that need to be done, that's where your buyer agent goes into battle for you again and gets with the seller on negotiating to see what they can get them to pay for it. The appraisal is done. It's back. You're ready to go. You're homeowners. So I love this. Experience matters. This is one of our clients that we've worked with. I would not buy a home or get a mortgage without Sandy and her team. We've used them 2 times and are completely satisfied. Their communication is top notch. Listen, who you partner with to get pre-approved matters. Now, is there 1,000 other things that will happen with getting pre-approved and becoming a first-time home buyer? There is. So I wanted to give you guys an intro into home ownership and let you know if you're looking to buy actually anywhere in the country, because the company I work for is licensed in every state. I am licensed in Arizona, California, Florida, Illinois, Minnesota, Missouri, Nebraska, South Dakota, Tennessee, and Virginia. We are here for you no matter what. So I would just love it if you gave us a call. My cell phone directly is 602-820-5166. Find us on Facebook, Instagram, LinkedIn, YouTube. If you have questions, hit me up. I would love to answer them and be there for you. Put my 39 years of mortgage experience to work for you. So I am going to stop recording. Maybe. And answer any of your questions that you may have. You can put them in the chat. You can unmic. You can do whatever you feel